One of the most important elements a new business owner must consider is to create a budget for a new company so he or she can see expected income, expenses, and cash needs. Since you have no past information to go on, you must create the budget using the best guess on income and expenses. Or if you are not sure on how to create a budget for your startup business, then welcome to my channel. I'm Michael Tadros, the professor. I have a diversified experience for many years, working as a consultant for startup businesses and entrepreneurs, as well as a project manager for Agile, Scrum, Lean, and conventional projects. Now, if you are ready, let's get to it. Before starting, let's think together about these coming questions. What do you need to open doors for your business on the first day? What will your fixed and variable costs be on a continuing basis? What can you do to keep costs as low as possible? What fund can you get from family or friends? Can you start, for example, without maybe expensive furniture, equipment, or some stationeries? When you find some answers to these questions, try to keep your must-have to the minimum. The less you need for your startup business, the sooner you can start making a profit. Now, let's quickly see how to create a budget for your startup business. Number 1. Plan for the day one of your business startup. Begin by determining what you will do on the day one of your business. A day one startup budget can be broken down into 4 categories. Facilities costs, including all costs of setting up a leased location. You may think of working from home, therefore you probably won't have location costs. But you may have costs for fix up a room in your home, for an office or a small production area in your basement. Fixed assets, sometimes called capital expenditures, including furniture, equipment, and maybe vehicles needed to set up your location and start your business. Materials and supplies, like office supplies, advertising, and promotion materials. You will need an initial supply for these to get started. Other costs, like the initial fees to an accountant to help you set up your accounting system, local licenses and permits, insurance deposits, and legal fees to register your business with government entities. Number 2. Estimate monthly fixed and variable expenses. Fixed expenses are costs that don't change and are not dependent on the number of customers you have. Gather information on your fixed expenses each month, such as rent, utilities, phones, including business phones and cell phones, credit card processing monthly fees, website service fees, equipment lease payments, office supplies, subscriptions to professional publications, business insurance, employees' salaries or benefits, business loan payment, etc. Variable expenses. They are expenses that will change with the number of customers you work with every month. This might include commissions on sales, production costs, raw materials, the wholesale price of goods to be resold, packaging and shipping costs, etc. Number 3. Estimate monthly sales. This is probably the most difficult part of your budget because you don't know what sales will be for a new company. You might consider doing 3 different sales projections. Best case scenario, in which you show the most optimistic estimate for the first year sales. Worst case scenario, in which you show your least optimistic scenario with very little sales during the first 6 months to a year. Likely scenario, which is somewhere in between. To be realistic in your budgeting, you must assume that not all sales will be collected. Depending on the type of business you have and the way customers pay, you might have a greater or smaller collections percentage. Include a collections percentage along with your estimate of sales for each month. For example, if your estimate sales in month 1 to be $50,000 and your collection percentage is 85%, show your cash for the months to be $42,500. Calculate the variable costs of sales for each month based on sales for the months. For example, if your estimated sales for a month are 2,500 units and your variable costs are $5.5 per unit, total variable cost for the month would be $13,750. Add monthly variable costs to monthly fixed costs to get total monthly costs. Number 4. Create a cash flow statement. Cash flow simply is the amount of money going into and out of your business each month. Begin your cash flow statement by combining total costs with total collections of money from all sales for each month. Remember that sales and collections might be different unless you have a cash or credit business. For the cash flow statement, you need to use collections. The monthly cash flow totals should look something like this. As we said, monthly sales $50,000, collected $42,500, total fixed costs $26,900, total variable costs are $13,750. From all of these, the total cash balance is $1,850. Don't forget that the $1,850 represents your total cash balance for the month, not your profit. Please also note that by changing your sales figures using the previous sales projection scenarios, you can see the results in your cash balance at the end of each month. This cash balance can give you information about your cash needs and how much you might need to borrow for working capital. Now, I believe you have more information about how to create a budget for your startup business. Thanks for joining me in this video. I hope you will join me again for the other ones. Therefore, if you have not already, now is the time to subscribe to my channel. Just click that button down below to subscribe and make sure you ring the bell so you get noticed when other videos come out. I look forward to talking to you at my next video. Have a wonderful day. Goodbye.